Hello, I'm Jeremy Allaire, and welcome to The Money Movement, a show where we explore the issues and ideas driving this brave new world of digital currency and blockchains. One of the major issues that has vexed policymakers and regulators and is really fundamental to the growth and adoption of cryptocurrency and blockchains are issues around financial privacy. This is coming even more into focus now, as blockchain payments built on stablecoins have really clearly become the killer app of blockchains, with their growth surging. And we're really, I think, very much entering an era that may really herald the mainstream era of digital currency for everyday payments and value exchange. How can we be assured of our privacy with blockchain payments? And are there risks of government and law enforcement overreach? And we're talking about not just the United States, but every country in the world and how they respect or don't respect financial privacy. Now, on the flip side, are there boundaries of financial privacy for individuals? Is there a social contract, so to speak, around the financial system that sacrifices some degree of privacy for the benefit of society? And fundamentally, are there risks that privacy-preserving technologies do pose to governments and their broader social mandates? A related issue is really around corporate and commercial privacy. Public blockchains and stablecoin payments that are running on those public networks are very, very powerful for corporations, but how can a company adopt this and not disclose private transaction activity as a firm with these public ledgers? And then, more broadly, what are the technology and policy answers to these questions? So a lot to cover here today, and to help us explore these topics, I'm very pleased to welcome two exceptional guests. Jerry Brito, founder and executive director of Coin Center, one of the preeminent think tanks on digital currency, and a firm that I know has done a lot of thinking on this topic specifically. And Paul Brody, a principal and global blockchain leader at Ernst & Young, and one of the drivers behind the Nightfall project, which aims to enable privacy-preserved payment transactions on Ethereum, while also enabling trusted third-party audits of those transactions. Welcome, Jerry and Paul.
Thanks for having us.
Excellent. Really excited to have you guys today. Maybe we'll just start a little bit with just quick intros. Maybe Jerry, just 30 seconds on what you're up to and sort of any background on the topic, and then we're going to really dive into the topic, of course, too.
Sure. Well, thank you, Jeremy, for having me. For those who don't know, I'm executive director of Coin Center, and Coin Center is a independent nonprofit based in DC, and we're focused on the public policy issues that affect cryptocurrencies and open blockchain networks, right? So things like Bitcoin, Ethereum, Zcash, Monero, and the like. And to date, those public policy issues that we've been focused on, which are many, have included securities law, consumer protection law, tax, but one that really has been a major issue since our inception about 6 years ago has been anti-money laundering, counter terrorism financing, know your customer type policy that's all based in the Bank Secrecy Act. And so, as you were saying, we have to find a balance between the understandable need of law enforcement and government to investigate crimes with the people's sort of need and right to privacy. And cash has been always sort of a main tool for achieving that privacy. And today, crypto is the new cash. And so we've been trying to figure out what's the right balance there. And so hopefully that's what we'll discuss, but that's one of our main focuses.
Excellent. Thank you, Jerry. Paul, quick introduction.
Sure. So I'm Paul Brody. I'm the global blockchain leader at EY. And we're obviously one of the world's biggest sort of accounting, tax, and professional services organizations. I lead all of our global blockchain teams, and the way that we really look at this is very, very focused on the enterprise side of things, right? So as a consumer, I very much value and care about my privacy, but a lot of consumers seem pretty comfortable with exchanging some level of privacy for access to convenience. That's certainly a model that's been established for a while. At the enterprise level, it's just a non-starter. If you don't have privacy in your business transactions, you're just not going to adopt almost any form of kind of digital technology. So for us, being focused on serving enterprises, that was early on one of our focuses. And a particular focus for us is how to do the maximum level of privacy that is fully consistent with regulatory compliance, right? You, in your introduction, Jeremy, you brought up things like overreach and other topics. And, we don't get to make a lot of the policy on that, but we have to be very, very focused on helping our clients be regulatory compliant.
Awesome. So, there's very much, what do individuals as sovereigns have vis-a-vis financial privacy? Obviously, corporations themselves are a nexus of contracts and bound by a series of laws, but also deeply focused on privacy, as much so certainly as individuals. Maybe we can maybe bring this up a level, and I'll turn to you first, Jerry, on this. But help us define financial privacy. What does that phrase mean to you? What's the essence of this idea of financial privacy?
So I kind of break it down into two parts, right? One is privacy from the state, right? And that means basically your Fourth Amendment rights to be free from searches and seizures, right? If the state wants to come and look at your papers and effects, they need to get a warrant from a judge before they can do that. So that's one kind of privacy that you have, and it's a privacy that's spelled out in the Constitution. The other kind of privacy, I would say, is things that you want to keep to yourself, things about you that you want to keep to yourself and you want to reveal selectively to different people. And so that could be, clearly, if you're going to open up a bank account, you're going to have to tell your bank certain facts about yourself. If you want to engage in a commercial contract with somebody, you're going to have to reveal certain things about yourself. But my neighbor doesn't need to know any of those things. And so my ability to keep certain things to myself and to reveal selectively those things to who I want to, that's sort of financial privacy as well. So to me, it's sort of those two things. It's one is an ability to maintain certain things to myself or reveal them. The other is my right to have sort of security without lacking a warrant from the state.
You sort of have these, these distinct boundaries, right? There's the boundary of my own, as you said, personal artifacts, records, and sort of a sanctity around that. But we understand if we want to interact with the broader financial system, we do give up some privacy, right? Certainly our identity, and certainly within the broader global landscape, the records of our transactions, we know that those are all reportable to government, subpoenable by government without our knowledge and without our consent.
And so that's where I think it gets a little tricky, because when you've voluntarily disclosed something to some counterparty, does that mean you've waived your Fourth Amendment rights? Maybe we don't have to go right to that, but that's actually something that
Patriot Act.
I don't think is as clear cut, right? And with cryptocurrency, I think it's interesting because the basically government's authority to require, as you said, without even your knowledge, that third parties like banks report information about you, turn over information, is predicated on the fact that you disclose it voluntarily to that bank. So there's a third party exemption to the Fourth Amendment requirement for a search warrant. Well, with cryptocurrency, if you're holding your own cryptocurrency in your own wallet, there is no third party.
Yeah. So I want to come to the profound issues that exist with digital currency, in particular, digital assets that are on public blockchains in a moment. But just tying back to this concept, I mean, the way I've articulated it is that basically because of the way that the infrastructure of money works in the world today, those businesses that are licensed to interact with what are called, money records, later database records called money, are are required by law, depending on where you are in the world, but let's just say it's the United States, are really required by law to be agents of law enforcement, to actually act as the front line of policing transactions. And in fact, if you don't, as a financial intermediary, proactively police transactions and report them to the government, you are in violation of your licenses, and you can get fined, you can go to jail. And so I don't actually think most individuals don't realize the fact that the financial intermediaries that they interact with are in fact agents of law enforcement and are required to be so. And that is the structure that we have today. You can obviously take it to the next level, which is, take a country like China, where the electronic money systems, right? The government can dive right into the records straight away. They can access them. They don't need to ask. They don't need a subpoena. They can just dive right in and take a look at whatever they want. So it's even less privacy there. But that is sort of the status quo in the financial system today, which leads us to, I think, this world of cryptocurrency. And I want to focus, most of our discussion today, not on the Bitcoins and Moneros and privacy focused, non-sovereign cryptocurrencies. Those are very one far end of the spectrum, but really zoning in on this world of stablecoins, theoretical central bank digital currency. But just for today, maybe we focus on stablecoins, where we're finally at a place where we have digital currencies that people want to transact for day-to-day things. They increasingly want to use those in commerce and in financial activities. And they do behave like, as you said, digital cash. And they act as kind of bearer instruments on the public internet, and it's possible for a person to kind of self-custody these things, and that raises a lot of issues. And so I'd love to hear you both talk a little bit about, from a policy maker perspective, or from a kind of a corporate accountability perspective, maybe both of those. What issues come to the fore when you have like a digital dollar stablecoin that's used on the public internet?
So from my point of view, right, a digital dollar on a public blockchain is essential for public blockchains to become enterprise usable. And that's not because cryptocurrencies aren't particularly useful, but because enterprises are inherently risk averse, right? If the model of how companies interact is basically, I have money, you have stuff, and we're going to exchange those things set to some terms and conditions, right? And as an enterprise, I want a couple of things. Number one, I want to minimize my risk. That means I don't want to convert my dollars, which I get from my customers and perhaps in retail stores, and to which I have to pay taxes on the other end of my earnings. I don't want to convert them to a different currency and then convert it back. It causes risk. That's foreign exchange risk. Companies hate risk, unnecessary risk. So enterprises want to stay in the same currency from end to end. So by enabling stablecoins on public blockchains, you're making public blockchains usable for enterprises, provided you can offer them privacy. What is exciting to me about the privacy approaches that are developing on public blockchains, especially the work we've been doing around zero knowledge proofs, is they have a potential to do two things. Number one, they make privacy practical, right? We just didn't have a practical, scalable mechanism for privacy on public blockchains previously that could handle not just a cryptocurrency, but pretty much any type of asset and even business logic. So that's making it useful, because if I have an exchange, not only do I want privacy about with whom I'm transacting and how much I'm paying, but also the terms and conditions of my deal also need to remain private. The second thing that's exciting to me is that the potential to change the way we interact with regulatory compliance in a way that's both consistent with the rules and potentially better. For the first time with zero knowledge proofs, we have this ability to prove something is true without disclosing the underlying data. Historically, all regulatory compliance has been based on, to prove something being true, you have to disclose the data. And once you've disclosed the data, it's now flowing freely across a bunch of different jurisdictions and rules. And so what I like about the potential for zero knowledge proofs is I can prove to you something is true, right? I can give you certain types of proofs that you need them, or third parties can provide proof, but the data is not out there. right? My data is not flowing freely. And when a regulator comes to me and says, I need you to show me that you did something, I can prove, thanks to blockchain records and mathematical proofs, that I did comply with the rules. And that has to me, there seems like there's great potential for positive proof of regulatory compliance and regulatory compliance without the disclosure of all of your personal information or business information.
Right. And this is, I think when a lot of people who operate in the existing, say, financial system or in other record keeping situations or situations where you're having to certify yourself in some way, right? We've just all become so accustomed to the idea that, like, no, you have to give your records, and all this information, all this personally identifiable information. And it's like we're spraying it all over the internet. It's creating a lot of issues. And I think when people hear crypto, they're generally like, ooh, crypto bad. Like, there's kind of like this, unfortunately, this reaction that somehow if you're doing something with crypto or encryption, you're hiding something, which is really, really unfortunate because, clearly what you're articulating is, hey, we're in this digital age. There's this massive proliferation of interactions that we have as individuals and as businesses. And we want to speed that up, make that better. But like, we want to do that without having all these risks of data breaches or intrusions and zero knowledge proofs, which for the audience that isn't familiar, as you said, is just using mathematical proofs to demonstrate that something is true without sharing the underlying data. And that is, it's a major, major breakthrough. And this is the crypto is not just good, it's great. It actually is like critical to moving forward in the world, in the digital economy and the like.
And I believe that zero knowledge proofs, crypto made them necessary for privacy, but I believe they will have a transformational effect on data and analytics over time for exactly this reason. Why do we store too much data? And we have gotten in this mentality of thinking more data, better. It's not. More data is more liability, more risk, more privacy breaches. It is not. More data isn't always better. And if we want to steward our clients' data responsibly, we have to start thinking about less data.
Yeah, so totally. Jerry, just, I know you talk to policymakers in DC a lot. You talk to, agencies and staffers, and, you have a lot of awareness on these issues. When you there's these hearings, I know you participate in quite a few hearings as well. There's always this question of, these public blockchain digital currencies, even the stablecoins that are out today, like USDC and others, there's still this sort of question of like, from a policy perspective, does this escape the anti-money laundering rules? Does this escape the requirements that the government has around the ability for law enforcement and the national security apparatus to do what it needs to do? What are you hearing on that? What do you think the current thinking is on that?
So I think that there's a spectrum of thinking on this, right? And it sort of changes from the more direct connection you have with the technology and government, where you're actually prosecuting cases or you're working on intelligence, you have a certain view, whereas folks of higher you go up on the chain, all the way up to cabinet, president, Congress, you have a different view. And I would say that at a very high level, there is misunderstanding oftentimes, there is skepticism, but it's just a matter of education. At a lower level, at a more direct contact with the technology level, there's a great deal of understanding. And there's also an understanding of what's possible and what's not possible. And that, I think, leads to good policy, right? Once you understand the parameters within what you have to work with, what you can expect to be revealed to you, what you can't, I think that leads to good policy. So right now, I would say that we're at a good spot when it comes to, say, stablecoins, because the law is pretty clear, right? So FinCEN issued guidance in May of last year, and that guidance was very clear. And so if you're a stablecoin issuer, then you're a financial institution that needs to be registered with FinCEN, and you have to know your customers, and you have to file suspicious activity reports and have an anti-money laundering program, et cetera. I think where there may be sort of questions that come up is, well, you have to know your customer, and clearly your customer is anybody who comes to you to exchange $1 for a stablecoin, or who comes to you with a stablecoin to exchange it for $1. Clearly your customer. But in between, you've got lots of different people who might come to possess that stablecoin, the same way that a dollar bill,
Sure.
you know, the bank knows who you are, and the bank knows who comes to it with $1, right? But in between, that dollar could pass lots of hands. Dollar bills, we really can't, there's nothing we can do. We can't really track those. But on a public blockchain, you can. So the question is, would at some point regulators come to the conclusion that a stablecoin issuer's customers are everybody who ever possesses that coin? And I think that's problematic for a whole host of reasons.
Yeah.
So I think that's one thing. And the other thing I would say, I totally agree with Paul that if we want to protect consumers and protect our own privacy, we want to limit where this information goes and where this information is reported. And so things like zero knowledge proofs are great because you can prove that you're compliant without sharing the info. But I see financial intelligence units like FinCEN increasingly think of themselves as big data operations.
Yeah.
Right? They see themselves as the people in government who are able to spot trends and spot things that need to be further investigated. And they can't do that unless they have a big data set. And so when you go to them, hey guys, great news, we can prove to you we're compliant without sharing the data. I wonder how they'll react to that.
Yeah, I mean, it's fascinating. I mean, there's we have the Financial Action Task Force, guidelines on the record keeping obligations of virtual asset service providers, whether you're a cryptocurrency exchange or a stablecoin issuer, and any of the above, and it's sort of taking the rules that FinCEN had prior established around know your customer's customer, and follow that money as it moves around the financial system, and sort of superimposing that on top of digital currency. And the industry is obviously doing a lot to ultimately be compliant with that. But what's interesting to me is that there's this huge opportunity right now to simultaneously meet that record keeping obligation while enhancing the privacy preserving characteristics through the use of things like zero knowledge proofs or multiple signature escrowed access to data and other things that can be done with crypto. But regulators are not hearing anything on that. They're basically saying, no, this is the way it's been done. This is the way it works. You got to do that. And it from my perspective, this could lead to actually a mass proliferation of our PII into more places on the internet that create more honeypots for hackers. And so, the digitalization of PII and its transmission, this is one of the things we got to be able to fix. And things like zero knowledge proofs can do that, but we probably need amendments to rules or adjustments to be able to get there. But it's interesting. I mean, what are from your perspective, again from both of you, what are the risks of overreach? And we don't need to go Orwellian here. I mean, we live in obviously a very complex world right now that is fast moving on a lot of different vectors right now, and challenging in many ways. And so it's not hard to imagine government overreach, not just in China, but in the United States or in other jurisdictions around the world that are in crisis right now. Lots of things can happen. Incentives can change. What are the real risks that happen here? What could go really badly for individuals and businesses?
From a business perspective, right, the biggest risk of regulatory overreach, set aside, particular U.S. law issues or other country law issues, the risk that exists overall is that historically, whether it's regulators or large enterprises, everybody wants control. And the problem with kind of having control, and this is what made people initially so uncomfortable about the internet, and what makes them uncomfortable about public blockchains is the lack of control. But what we found last year, what we find over and over again is if one party controls a network, the other parties don't want to join. So the biggest risk of kind of overreach is that people decide that they don't want to adopt new technology because it presents too much of a substantial risk. And I'll give you a very good example. One of the main ways that manufacturing companies connect to each other is through a system called EDI, Electronic Data Interchange. It's literally as old as I am, which is obviously in my early 20s. But it actually dates from the 1970s. And it's a point-to-point messaging system. And it doesn't work really well if you think about the fact that large supply chains or business operations are actually involve dozens or hundreds of companies across many different countries, right? This is basically saying, I'll only allow you to send a message from one person to another. You're playing a game of telephone, and inevitably the message gets delayed and it gets garbled and causes supply chain foul-ups, right? That technology is still the primary technology used because companies are reluctant to put their data into somebody else's centrally operated system. Blockchains could have a huge impact on freeing up supply chains, improving the flow of data, reducing inventory, improving working capital, speeding up payments, but they won't happen if every company or country thinks, I don't want to sign up for a system that's controlled by a rival government, by a potential competitor. So the bottom line is that if overreach exists, people will not, companies especially, will not adopt a new technology if they believe their business security, their business privacy, their strategic value is at risk. And that's
sort of a good argument for
an enterprise.
For public chains as the right infrastructure, because it's non-aligned, right? It's not aligned, it's not controlled. You know, we see very governments with a lot of farsight, like the government of Singapore, they've been very explicit. When they've asked us to work on stuff for them, they've said it's got to be open source, it's got to be public domain, right? It's got to be built on open standards. Right.
That's the kind of stuff that will get adopted. And I think that you know, that's the big downside. We're gonna say no thanks to a lot of productivity gains if somebody decides that they must have control or they must have the data over others.
Yeah.
So what I worry about with government overreach is politicization of financial intermediaries, right? And what I mean by that is this: in an increasingly cashless world, right, where almost all transactions are meaningful transactions are going to be digital, you're going to have to employ an intermediary, and that intermediary is sort of beholden to their regulator or their supervisor, and that ultimately is a political actor. Mm-hmm. And you know, right now, to date, you know, we haven't seen too many abuses, but you can imagine that political person saying, don't process, you know, transactions for my political enemies. And we've seen this, right? So an example that I like to point out that some folks aren't aware of is, I think it's almost 2 years ago, this started happening, where Governor Cuomo in New York, after one of these terrible school shootings, basically said, he directed the New York Department of Financial Services to basically tell its regulated banks and insurance companies to stop doing business with the NRA. Mm-hmm. And if they didn't stop doing business with the NRA, they would be investigated, and maybe their licenses would be in question. Now, you know, whatever you may think about the NRA is a nonprofit that does what? It uses its First Amendment rights to speech and association in order to defend another constitutional right, a Second Amendment. And look, Governor Cuomo is basically saying, I'm going to put it out of business because they disagree with me on policy. Yeah. And I'm going to do that by saying you cannot transact in this country because of intermediaries.
Right. We're obviously seeing enormous politicization of all kinds of things these days. And a disregard for constitutional mandates and other things. So it's the risks are real, and they're not theoretical. And we're not just talking about China, you know, because everyone likes to point to China as, you know, or an authoritarian government. Those risks certainly are real. Which actually maybe it's a segue a little bit into. We have this private sector universe. We've got the, you know, decentralized, non-sovereign digital currencies. We've got, you know, private sector issued stablecoins. we're going to, big arrangements that kind of make those work and scale. But we also have, proactive discussion on the government issuing its own digital currency, a la what China is doing. And this is something, lots of governments are contemplating and, potentially, theoretically inserting themselves into the identity and transaction history relationship at the token holder level. And, it is in the dialogues around this, it's certainly, these privacy questions are really coming into play. And on the one hand, people are saying this could get very dystopian, and we need to maintain some of the boundaries that we have. But I know that's something that you guys at Coin Center have been plugged into and thinking about a bit.
Yeah, so it's funny because something like a central bank digital currency is kind of outside of our remit. But obviously, being digital currency experts, we have ideas about it. So I'll just tell you what my personal ideas about it are. And it's this, is that there's basically been discussion about two possibilities for a digital dollar or central bank digital currency. One would be account-based, where basically the Fed opens up accounts for individuals. The other is token-based, right? In my mind, there's all the value that you would want is in a token-based system. An account-based digital dollar system is basically a public option for banking, which maybe that's great if you're looking to expand access. But the real opportunity in creating a digital currency for the dollar is making it bearer, making it programmable, right? Making it universal. And so if I'm in Rwanda and I want to engage on a regular contract and payments with somebody in Pakistan, right? And I want to use the dollar because the dollar is the best money there is, I really can't open a Fed account.
Right.
So that excludes me. So
Yep.
It's got to be token-based. And if it's token-based, to really, again, meet its potential, it's got to be private.
Mm-hmm.
Right? If it's not private, again, it doesn't work.
Yeah. Yeah. I mean, this is, something that I'm sure you both have reflections on, but, the internet has given us, peer-to-peer communications. It's given us, peer-to-peer data exchange. It's given us permissionless decentralized infrastructure for all of these things. And, if you would have gone back 30 years ago and said, anyone in the world can kind of, broadcast privately, securely to anyone else, for free, without any eavesdropping or whatever, it would be like, what are you, out of your mind? There's so many things that the open internet has allowed for, which, fundamentally just kind of mowed over existing institutional understandings, even policy and regulatory frameworks that existed. One could argue about some of those maybe have gone too far, but nonetheless, the internet has allowed this, and token-based, stable coins, or whether they're somehow there's a backing that is official, i.e., it's the reserves are in a central bank or whatever that model is. The internet gives us this ability to transact with anyone, anywhere, directly over a public network in this bearer instrument way. And that's, and programmable and all these things that you talked about, that's like a really big breakthrough for the world. And, it strikes me that, we really ought to defend that and defend the possibilities that come from that, and what that means for people and what that means for businesses.
And
I certainly, sorry, go ahead.
No, go ahead, Paul.
I was going to say, I certainly think from a public policy perspective, we need to find a way to balance the regulatory compliance with the privacy component, because the dollar is the world's de facto currency, but it will not stay that way if there's no way easily for people outside the United States to make use of that, right? And it has become, we have been raising the barriers to entry. One of my early jobs, I worked in West Africa, right? The dollar was a de facto currency. People paid their bills in dollars business-to-business transactions were done in dollars, but they were done in cash, right? And I can actually remember, holding what to me seemed like terrifying amounts of cash, but it was really useful because the dollar was such a reliable and stable currency. I think, a completely private token-based dollar would be a boon to money launderers and drug dealers and terrorists, and that's not something I want to see. But I also don't want to see it become impossible for individual users to have some personal privacy and for there to be relatively low barriers to entry. One of the things that is being looked at in China and people have talked about is a kind of a blended model where up to a certain amount of digital currency, you can have it and it operates like cash. It is effectively anonymous. There's no kind of barriers to entry and things like that. I think we have to think about something like that. I think, back in the good old days when we traveled internationally, you remember those just a few months ago, right? I think if you left the country, you moved around with more than a certain amount of money, you had to declare it, but nobody bothered you if you had a bit of cash in your wallet, right? And I think we need to figure out how to do that. But if we don't, to me, there's big economic policy implications for the loss of the dollar as the global reserve currency. And then secondly, I think the question that we often turn over in our minds is, central bank digital currency, they sound nice, but what's obscured from this conversation all the time is the fact that almost all central bank transactions are already digital. And I have not heard, in many cases, a really compelling explanation for why central banks want to build a private blockchain that's not customer accessible, that doesn't support public blockchain transactions. That sounds to me like just another digital interbank payment systems. And I'm not clear always on the value proposition of why it should be a blockchain, a DLT, or some kind of other token-based system. And that's not been clearly articulated yet. And I think that's one of the reasons why you have seen a fair amount of experimentation, but not a specific push in a particular country outside of China.
Yeah.
Digital currency enthusiasts and Bitcoiners for a long time have pointed out HTTP error 402, I think, which is the no payment, and saying, look, we were ready for web native digital payments, but they never happened. And Bitcoin or something like it was going to be it, and that hasn't happened in large part because of Bitcoin's volatility. So stablecoins now have the promise of being say a dollar stablecoin, being that programmable money that can be the native money of the web. But the problem there is you've got lots of different standards, lots of different kinds. That's what I think, if I was making policy for the US and central bank digital currency, boy, could you imagine what a official dollar coin would be? Now, I think if you game it all out, and I've done a lot of thinking about this, if you game it all out, I think Paul is right that the settlement that makes the most sense at the end of the day is going to be having cash-like properties up to a certain amount, but above that, have it be traced in some way. The problem is, I don't see how that's technically possible with a token-based model.
So I do. We think about this all the time, obviously, at Circle with USDC, and I think in fact the work that FATF has put forward and this work around travel, it basically defines a way to do this. I mean, it basically says, look, these are token based, they're bearer instruments, they can exist on a public blockchain. But if you're a VASP or you're an intermediary that's dealing in these, which is now becoming pretty uniform around the world, that if you're dealing in these things as a business, you have to do this with these rules. You need to keep records for things above $1,000, mm-hmm. And that's sort of the compromise position. They're all the same underlying digital cash instruments. They're all still the same. It's just if it's above $1,000, you're going to have to exchange a little bit more data, et cetera. And they ultimately still allow for individuals to self-custody as well. But it's the same kind of thing. Like I could self-custody, $1 million in $100 bills. Like I have the ability to do that. But if I show up at a bank with that, they're going to want a lot of information from me in order to convert that into something that they're holding or investing on my behalf. And so, these sort of cash-like rules and these record-keeping rules, I think they can work and they can apply and still give that access in West Africa, or that programmability, or that base layer of privacy that people are interested in.
Yeah, I totally agree with you. I totally agree with you that it's doable today, but when a CBDC is being designed from scratch, and so what abilities will it provide for individuals are being designed from scratch? Will a state designer make it such so that it mimics cash completely? And I fear not. They're going to listen to the Ken Rogoffs of the world and say, no, there's no real legitimate reason why anybody has to have $1 million.
Yeah, this is a bigger question.
So, but I think this is where the power of public blockchains comes in, and this gets debated over and over again, and I really encourage people. There was an article, I want to say 15 years ago in Wired magazine. It was called "The Netheads versus the Bellheads," and it was about the early origins of the internet and the transition to IP. And I'll tell you, all the really smart people said that there was no scope for this chaotic, unstructured internet protocol. It's never going to scale. People aren't going to use it. It doesn't have quality of service, right? I think the market tends to speak very effectively in that respect. I think if you design a system that doesn't provide for a lot of flexibility, that doesn't support open access, that isn't built on a genuinely open source model, you won't get a lot of adoption. Certainly you'll find some people who will adopt it. And we could have a whole separate episode on what I think is actually some very far-sighted and thoughtful regulation thoughts that are coming out of mainland China with regard to their market. But I think, particularly in the US and Europe, if it's not open source, if it's not public domain, if it doesn't run on public blockchains, people can design whatever they want. I'm not sure it's going to get adopted, right? There's hundreds and hundreds of private blockchains, and they have like zero traction. They're just like, they're empty shopping malls.
I'm totally with you on that. And I think, kind of private sector is racing ahead. The open standards, open source world is racing ahead. And ultimately, I think that's what's going to get the adoption and traction. And central banks will have supervisory standards, right? They'll versus like, we're going to go clean room, build this. Well, there's a lot we could continue to talk about here. This has been an excellent conversation today, and would love to have you guys back on other topics as well. But thank you so much for joining today.
Thanks, Jeremy.
Absolutely. So very interesting juxtaposition of issues here, and we're really right now right in the thick of it as stablecoins take off, as policymakers respond and set standards, as the entire industry, both the digital currency industry and traditional financial institutions, are figuring out, okay, now how do we do this at scale with mainstream adoption? So these financial privacy issues are at the forefront, and we'll come back to that topic again. So next week, we're going to be having some guests for what I think is going to be a very timely episode of the Money Movement, where we're going to be talking about banking meets stablecoins. And obviously big news was this week where the Treasury Department issued guidelines for federally chartered banks that said that they are permitted to, and in some ways were encouraged, that they could custody cryptocurrency and crypto assets. That's a very significant impact, and I think the banking sector, it opens up a tremendous opportunity for the banking sector to get more involved with cryptocurrency and with stablecoins in particular. So, at Circle, we're seeing accelerated interest from neobanks, from fintechs, from global banks on adopting digital currency and stablecoins as a payment and settlement medium. And we expect this to be a major theme in the coming year. So joining us next Thursday are 3 guests, including Oliver von Landsberg-Saadi, the founder and CEO of BCB Group, a European neobank embracing stablecoins as a core payment medium. Julian Howell, who's the head of blockchain lab at Bank Frick and Company AG, similarly a fast-growing European neobank that has adopted USDC as an alternative to SWIFT for international dollar settlements. And Michael Morrow, the Chief Executive Officer of Genesis, who is perhaps the largest institutional lending facility in crypto and whose firm is driving and building significant stablecoin-based credit markets. So some very interesting kind of convergence of what we think of as banking with stablecoins. So looking forward to next week. And until next time, stay well, stay safe, and stay informed. Thank you.